All right, so part 2 on how to maximize your charitable contributions without eliminating your children as beneficiaries of your accounts as well. So that's what we're going to talk about here as part 2. So welcome to Heritage Wealth Planning. Don't forget to subscribe down below. And of course, as always, if you like what you see, thumbs up. And then, of course, comments always helpful as well. So last time we talked about a simple estate planning technique it's simple, but a lot of people overlook it, where you don't leave IRA money to kids, you leave IRA money to the church, and you leave taxable money to your children, because your children can inherit the taxable money tax-free because of the step-up and basis rules, and the church inherits your IRA money tax-free as well because they're a qualified charity, all right? What, 501(c)(3) or 501(c)(3). All right, but what if all your money's in an IRA? All right, so say, or the bulk of your money, let's just say you got IRA money in your home, and we'll just use that. And so we're not going to talk about your home as part of your liquid net worth, but let's say you have everything is in an IRA, 401k, 403b, qualified annuity, some kind of tax-deferred account. And you're like, man, I like that idea, Josh. I like leaving the church tax-free money, and I like leaving my kids tax-free money, but I don't know how to do this, because everything I have is tax deferred, and I don't want to give to my church at the exclusion of my kids. Well, here's the answer. It's easy, actually. So here, again, the goal is leave money to kids, leave money to charity. Well, here's the simple solution. It's with life insurance. Ah, life insurance! Oh no, Josh is going to sell his life insurance. Doggone right. When it comes to charitable estate planning, leaving your kids, life insurance needs to be part of the equation. You're absolutely right. And it's so easy. And I don't know why people can't see. I don't understand why people get so angry about life insurance that the minute you say life insurance, they run for the hills when there's so much value in it. It's almost like saying the word annuity. People are like, I cannot tell you how many times USA had the wonderful annuity called the Flexible Retirement Annuity, FRAN for short, Flexible Retirement Annuity. It's a fantastic account. Everyone should own it. And look, I'm not saying you should. I'm not saying that. Just like, take that back. Should you own it? Maybe. But there are significant benefits to owning the Flexible Retirement Annuity. I cannot stress enough. And yet the minute you said that to somebody, they would thought you were trying to sell their daughter to freaking Somali pirates or something like that. It was nuts. And I'm sitting there thinking, anyway, all right. So life insurance. All right, so you got $200,000. It's all in an IRA. And you have these two goals, to leave money to the kids and to leave money to your church. All right, now you're saying, again, all your income needs are met by other sources, Social Security, pension, and I'm not talking RMDs here because we're going to use that for a second, but all your income needs are met by other entities. So you don't need to draw on this money to pay the bills. You don't. All right, so what you do is you say, I'm going to buy a life insurance policy, and I'm going to buy one for $250,000. I'm just throwing that number out there. And it's going to cost $5,000 a year. I'm 65 years old. I'm literally just throwing that. I don't have any clue at all. I don't have any clue. I just know for $250,000 life insurance, and this is one that you would not want whole life. You don't want whole life. You want something that doesn't maximize cash value. You don't want anything big on cash value. You want essentially a guaranteed death benefit for as limited cash value as you can possibly get. One of the reasons USA had a hard time with their estate planning is because their life insurance policies maximize cash value. We don't want cash value in this because we aren't going to tap into it as the owner. We want minimal cash value, just enough to keep the policy in force so that when we die, the policy is still in force. So there's a lot going on in that statement right there. I'm just telling you, we don't care about cash value if we're trying to leave a legacy through life insurance. We just need it just enough to keep the policy in force. So it's a guaranteed universal life is what it was. We had a minimal cash value, but had a guarantee. So as long as you made the premium payments, it would not ever expire. That's a GUL, a guaranteed universal life is what you want here. Maybe I'll do a thing on just that specifically. That'd probably be a good video. All right, let's get this concept done first. All right, so in this case, I should do a video on life insurance and how you can use it for death benefit planning, estate planning. There's a lot going on there, and if you don't understand it, or if you're talking to a guy, like this guy was emailing me, it's just unfortunately just new to the business, and he didn't really know what he didn't know, which is scary. And I'm going to have to do something like that. Okay. Anyway, so in this case, we got $200,000 in our IRA. We're pulling $5,000 a year out. We're just, I'm not talking taxes. I'm assuming you're in a low tax bracket. Maybe it's not even taxable to you, but even if it's taxable to you, it will be taxed as ordinary income. But we're just using that $5,000. And we're going to use that money to buy a $250,000 guaranteed universal life insurance policy. That way we know that when we die, that $250,000 will be there. Now, is there any risk? Yeah, you might not get underwritten. You might have cancer, terminal illness. I mean, never going to get insurance when your house is already on fire. So if you're already in a world of hurt, you're not getting life insurance for sure, which is why you get life insurance when you don't need it. All right, and I don't know, frankly, if $5,000 would be enough to cover a $250,000 benefit. I think it would if you bought it in your mid to late 60s, as long as no significant health issues. I absolutely do. In this case, I want to talk about what's called survivorship life insurance, second to die life insurance, because in that case, I think I was doing $250,000 policies just 10 years ago on for $3,000 a year, $250 a month. And what a second to die life insurance policy is, and I probably should just draw this up there, but just so I'm yapping. You got Charlotte and you got Josh. All right, so Josh is a man, Josh is older. All right, so the likelihood of me surviving Charlotte is basically nil. So what you do is you underwrite it for both Charlotte and me. All right, so basically I'm being underwritten, but I'm not likely, the life insurance isn't going to pay out on my death. It's going to pay out on the second to die. It's going to pay out on Charlotte's death. And that's confusing to a lot of people, but why second to die life insurance is such a wonderful concept for people looking for estate planning is that my death, Charlotte doesn't get paid. Only at her death do our heirs get paid. So in this example, $5,000 would certainly buy more than $250,000 of second to die life insurance. It depends on your age. It depends on the underwriting. A lot of men have high diabetes, kind of heavy, whatnot. What's the other one? A lot of blood issues, where the woman is usually in better shape. And so at the end of the day, you're like, I'm not going to be able to get life insurance. I'm not in great shape. It really doesn't matter for you. It matters for the person who's likely to survive. In this case, a woman who's younger than the man. So they don't really care about you so much when you're going through underwriting on a second to die life insurance policy, because they're already assuming you're going to die first. So they really don't care that much about you. The insurance company is wondering how long it's going to take for the woman to die before they have to pay that claim. Does that make sense? So when you're doing an SUL, second to die, a survivorship universal life, Knights of Columbus, they call it dual life policy. Anyway, I'll get into a thing on Knights of Columbus at some other point. Oh, yeah. Again, when you're dealing with insurance agents, if they don't know what they're doing, it's scary. You got to get someone who knows what they're doing, that's for sure. But anyway, so when you're dealing with second to die life insurance and you go up there and say, oh, you're never going to get it underwrite me because I'm a man and I'm smoke and I got whatever. They don't care. I mean, they do care to some degree, but they'll underwrite it based on the healthier of the persons, and usually it's a woman who's younger, who's more likely to survive. Because all the insurance company cares about is the premiums that they're going to get paid. They want to make sure they get enough premiums paid where they can use those premiums to generate interest, to generate growth, to cover that $250,000 liability. So that's why they don't insure you on your home if your house is already burning, because they haven't received enough premiums to cover the liability they have to rebuild your house. And that's why when you're doing life insurance, it doesn't cost very much the younger you are, because you're not likely to die. And so they know they'll get enough premiums over the course of that policy's term to cover the liability that they have here. So $5,000 on a second to die life insurance, I bet would actually, if you're mid to late 60s and relatively healthy, I bet you'd buy more than $250. At least that's what I used to do. I don't know anymore. I used to use the John Hancock, had a GUL, which is wonderful. John Hancock guaranteed second to die life insurance. It was a great product, and frankly, it has been 10 years since I've used it. I have no clue what it is now, but I was a huge fan, probably 8 years, huge fan of that for estate planning. So remember, with second to die, you got $250,000 life insurance. I die. Charlotte doesn't get any money. It doesn't go into effect until she dies. So you're not providing life insurance to cover your surviving spouse when it comes to second to die life insurance. You're providing life insurance to cover your estate or your heirs in this case. Sometimes they use it for estate taxes. We're not really doing that here today because we don't have to worry about that so much. But you're providing it for a surviving spouse's death to your heirs. I hope that makes sense. It's critically important to understand how second to die life insurance works. I just real quick again, Charlotte and Josh, one of us dies. The survivor does not get life insurance benefits. It's only at the death of the survivor does life insurance get paid. So if I am worried about Charlotte's ability to make ends meet when I die, I do not want to get a second to die life insurance policy. That does not make sense. That's the worst thing I can do, actually, because I still got to pay the premiums, which is money out of my pocket and her pocket that we could be using to build up our portfolio, our net worth. Don't get second to die life insurance if you're worried about your surviving spouse. That's dumb, and if any agent did that, they should be strung up. You want to get second to die life insurance because it can provide an immediate, instant estate that's tax-free. So we're going to assume, in this case, as husband and wife, $5,000 a year is their premium, and they're buying a second to die life insurance policy. I think that's probably a little bit generous. I think you could probably buy more than that, or a little bit conservative. I think you'd probably buy more than that. But the same concept would work here even if you weren't married, even if you're single. If you had $5,000 and let's just say you're a widow and you're buying a life insurance policy to cover $250,000, the same concept's applicable here. There's no other way around that. I just don't think if it's a second to die, you're not going to get the same bang. If you're a single life insurance insured, a widow, you're not going to get the same bang for your buck as you would for a second to die, just because there's more risk to the insurance company for one life than there is for two. I know it's a lot to chomp on. I hope I haven't lost you here. It's pretty critical to understand this. So I'll probably do another video just on that alone, because I did want to do in the context of this example. All right, so $200,000 in an IRA. We're pulling $5,000 a year to buy a $250,000 life insurance policy. We're going to assume we die in 20 years. All right, so how much did we pay for this life insurance policy? Well, 5,000 times 20. Get my bat cents up there. It says we paid $100,000. All right, so we're able to take out $5,000 a year for 20 years. That's $100,000 it cost us, and we've converted that $100,000 to $250,000 of tax-free money to my heirs, because we don't want the heirs to inherit IRAs. We want heirs to inherit non-IRA accounts. Life insurance is preferable. Stocks and bonds and real estate is fine too. Just anything that's not inside an IRA. So we are down $100,000 in total wealth because of the premium cost. But when we die, we actually be made out like a bandit. We've leveraged life insurance to provide a bigger estate. On the other hand, too, watch this. So you're pulling that $200,000. You have your IRA, and you're making the church the beneficiary. You have this $200,000 is being reduced by $5,000 a year. And here I just said, what if we took $5,000 a year out and we have a 5% year-over-year rate of return? Well, in this case, I'm leaving $365 to the church. So I took $5,000 a year out of my IRA. Now, again, that's paying taxes outside of this amount, which buys me $250,000 of life insurance that I give to my kids tax-free. And the money is still growing each and every year. Even though I'm pulling $5,000 a year out, it's still growing at 5% a year. And you can run these numbers any which way you want. So now I'm leaving my church $365,000. I hope that makes sense. So now you might say, well, I don't want to leave my church more than my kids. Well, you can finagle this any way you want. But at the end of the day, the issue is you're pulling this money out and it's costing you something. So it costs you $100,000 over 20 years in which to leave $250 plus 3, that's $715,000. Yeah, or $615,000. So you started with $200,000. It costs you $100,000, and you're leaving $615,000 to your church and to your heirs. That's not too bad. And again, that's tax-free, and this is tax-free as well. That's how life insurance can be played, by using it properly, designing the proper mechanism without really any fuss. Now, in this case, you're saying, oh, the RMDs. Well, this would certainly cover the RMDs for, I mean, you're talking $200,000 of RMDs. Let's see, 200,000, divide that by 27.4. So it won't cover your RMD. So you still have to take out more than that for required minimum distributions. I didn't get it. I'm just using this for example. So it would cost you. You would have to take $7,300 the first year. So in that case, you can take the RMDs and you use the RMDs in which to buy even bigger life insurance policy. Ultimately, you leave less to the church and more to the kids. Either way, the construct is just wonderful. It's awesome. The question comes into mind is, A, are you hating on life insurance? And you shouldn't be. Life insurance is a wonderful tool for estate planning. B, can you qualify? I mean, if you're smoking and going skydiving while you got heroin needles up your arm, you're not going to get qualified. There's just no other way around that. C, we got to make sure the policy stays in force. That means it survives you. We can't have you dying before the policy does. So again, high cash value components of life insurance for estate planning we don't want. We do not want that. And if I see a life insurance agent talking high cash value when your idea is to get estate planning, that agent isn't worth it. It's not. That agent's worse than being bad. So we don't want that. I guess that's it. So I hope this helps. As always, if you have questions, thoughts, concerns, let me know. If this is helpful to you, I do have a donation, and I'm not afraid to ask for money. I mean, my goodness, I need money. Everybody needs money. So I did start with a donation thing on PayPal. I'll put a link in my show notes. So if you're still here and you're like, hey, Josh, that's pretty good. It's worth, $15-10 to you, man, donate some money. I appreciate that. Obviously I have nothing to give you other than I'll keep doing these YouTube channels, but it's it's a way I've heard enough people say I'd like to donate to you that I figure I'll start a donation tab. And if that helps you, man, more power to you. If it helps you but you don't want to donate, it's fine. I'm watching you. You didn't donate to me. How am I going to eat lunch? No, I don't do that. But if you find value, you want to donate, by all means do so. Secondly, don't forget to subscribe. And of course, always thumbs up, questions, comments, concerns, help me, and we'll see you next time. Thanks, guys.